Hi, value investors. Welcome to my channel. Apple is releasing its quarterly reports, so I really wanted to make a video in order to emphasize what are the most important factors that really have created value for the long term for Apple's shareholders over the years. So this is important to understand because most people is just focused on the quarterly performance, but really, we are talking about a retail company like Apple. Of course, the demand for its products could slow down in some quarters just because of the macroeconomic situation and so forth, but not because the company is doing something wrong. So really, we need to avoid these kind of strategies for the short term, and we need to focus more in the long term. You need to remember that Tim Cook has launched different long-term strategies for this company. The capital allocation of the company is oriented to reward long-term holders, which is something really important. And you should remember that all these aspects, of course, may have attracted a super investor like Warren Buffett. And look at this, of course, in the case of Warren Buffett, Apple represent something like or something close to 40% of the total Berkshire stock portfolio. The Berkshire stock portfolio here, and look at this, that Apple represents something close to 40% of the total Berkshire stock portfolio here. You need to remember that Warren Buffett started buying these shares in the year 2016 at a $25 per share. And well, the thing here is that he has been increasing his position over the years. And then, well, except for the sales of the shares in the year 2019, 2018, but then Berkshire started buying again Apple stock in the year 2021, 2022. So really, this is a stock with the highest conviction within this portfolio. Now, something that I remembered about Warren Buffett, he has said in one of his shareholder annual meetings about Apple was it's a strong program of share buybacks. And you need to remember that most analysts are focusing just in the revenue growth of this company, comparing, for example, with the revenue growth of other companies like Microsoft, Meta, or Google. But they don't take into account that we are talking about a retail company that offers and delivers physical products. So we cannot imagine a double-digit growth in revenues here for this company. Now, something that is overlooked by many analysts and many investors is that the main source of value for this company is the free cash flow generation of this company. And this is important because, of course, this strong share paybacks is supported by this high free cash flow generated by the company. And of course, the share payback program is designed to deliver long-term value for all the long-term shareholders of this company here. But before going into the assessment of this interesting company, I want to remind you that I'm writing for Seeking Alpha as a contributor here. Now, this is my page in Seeking Alpha here. You can follow me here. You can find interesting information. For example, my last two articles here. This is really interesting because, well, you know that these kind of articles require a lot of research. And, well, you know that in the case of Seeking Alpha, the readers of this website are rather sophisticated investors. So they demand, of course, high quality and unique articles here. Really, look at this in the case, for example, of my last article about Alibaba. We're talking about the implication of the new reorganization of Alibaba in the value of this company. And you know that the company is being separated into 6 different business units, and most of them with the possibility to launch future IPOs. This is something because this will enable the market to unlock value here. And well, in this case, for example, I'm just making calculation of the intrinsic value with using the sum of the parts of each business unit here, because I'm calculating intrinsic value of each business unit to calculate the final intrinsic value for this company here. I'm sure that you will benefit for this information here. And you will know, for example, if you are not holding Alibaba, and you can find new opportunities. For example, if you are interested only in the cloud, one of the business unit that could launch a new IPO in the future. So really, this is a really interesting thing to know about this company. Then, well, in another article, I'm just, well, thinking about the Ant Group here, because really there's not so much information about Ant Group, particularly after the crackdown in the year 2020. And then, well, I think that I needed to make a lot of research about in order to write this article. And well, you will find interesting information about the ongoing process that this company is facing right now to be transformed to a financial entity. And well, the thing is that I've written as well other articles, for example, related to Viva System, which is a company that offers cloud services to the pharmaceutical industry, or well, in the case of Apple, this is the company, of course, that we are going to talk about in this video. And then we'll look at this at Amadeus IT Group, which is a really an outstanding company exposed to the travel and tourism sector. And you know that this is a sector that is recovering faster here. Now, coming back to our assessment here, I want to show you here the revenue breakdown of this company. I wanted to understand what is happening here. Look at this, that this is not a surprise that the iPhone concentrates most of the total sales of the company. In the year 2017, for example, the concentration of the iPhone was 61%, but now that concentration has been declining here until it reached the 52% here. But something really interesting is how the services are increasing its participation within the total sales of this company until reach the 20% in the year 2022 here. It's important to notice here that yes, the services are increasing its participation, and I'm impressed really with the services because not only we know about, for example, Apple TV, Apple Music, but there are other kind of services like for example, like a fintech. This kind of services related to the cash management of the users. For example, the Apple Card, the Apple Pay, the program of buy now pay later, the new saving account recently launched by the company that offers 4.15% annual yield. All these kind of things really are reinforcing the mode of this company. And thanks to all this cash management, for example, the company is pushing up even more the sales of these devices here. For example, if you are up using the program buy now pay later, you can buy, for example, an iPhone, an iMac, or iPad in installments really, so you don't have to pay all the price really in advance. So really, this is really interesting because this is the kind of things that reinforce the ecosystem of Apple, and of course reinforce the stickiness that all the users feel respect to the Apple's ecosystem. And well, this is just the growth in the case of the iPhone here, year over year. Well, there are some negative growth here in some years, but this is something that we should expect, of course, in the following years, because really we are talking about a mature market, like in the case of the iPhone. Really, I don't think so that we should expect, of course, a revenue growth of double-digit growth in this market. And look at this, that this, of course, in this year, the year 2021, this is just a one-off. Look at the total sales of the company, 33% in the year 2021. It was just because remember that the Federal Reserve introduced so much liquidity into the system, into the economy in order to mitigate the effects of the COVID. And in this way, for example, most people felt that they had so much money in their pockets, and they started buying more Apple's devices, which is something good for the company, of course, because it reveals the preference of the buyers in general in the economy for toward Apple's products. But really, this is just a one-off situation here. This is not a recurrent situation. So really, we should expect, of course, a one-digit growth in revenues for the next year. This is something that I'm assuming, for example, in my calculation of the intrinsic value, I'm just assuming just a 3% of revenue growth for this company. Because you need to remember what is the most important source of value is the cash flow generation. And you will be surprised how the free cash flow of this company was growing in the last 10 years, really. If you are, for example, concerned about the quarterly performance of this company, you shouldn't be worried about the performance, because you need to be focused more in the factors that explain the long-term value for this company. And I'm sure that, for example, a super investor like Warren Buffett will not be so much interested in the negative performance of some quarters in this company here. Now, these are the metrics of the company here from the year 2010 to the year 2022 here. And look at this. This is something that is frequently overlooked by some bear analysts. It is the fact that, well, look at this, that the outstanding number of shares of Apple are being reduced year over year and then abruptly increase in the year, for example, the year 2020, and in the year 2000, for example, in the year 2013, really. Well, so really, well, this reduction, the outstanding number of shares are explained because the company likes to apply this strong share buyback program here of buying its own shares. But the company really likes as well to apply this kind of a split policy. And well, the thing is that really I didn't know why this company was doing something like that. I mean, the splits policy. And I remember that Tim Cook in the year 2020 said that he wanted that smaller retail investors could afford Apple shares here. Well, I didn't understand what was the benefit of that at the beginning, but then what really Tim Cook wanted was to attract the right type of investor to the company. You need to remember that Tim Cook has repeated several times Apple is carefully designed to reward long-term shareholders. And this is because, of course, the strategy of the company is thought to deliver value in the long term. The culture of the company, the capital allocation, all these aspects that are frequently overlooked by beer analysts are designed to deliver long-term value. And now the thing here is that with this splits policy, I mean, what you are doing really is that you are increasing your outstanding number of shares, and the share price will be reduced in the same proportion. This is what has happened, for example, in the year 2020 when a split of 4-1 was announced by Tim Cook. And then, well, the thing here is that in theory, the market cap should not be changed at all. But these kind of policies end up boosting the market cap of the company in the long term. And this is because Tim Cook want to attract more and more retailer investors to think in the very long term. And of course, given the fact that he has given this kind of communication that he wants that Apple is designed for long-term investors, this kind of split policy really attract more and more retailer investors for the company. In the end, this kind of support of the retailer investors has been reinforced since the year 2016 when Warren Buffett has bought the shares for the first time. And of course, you know that there are, I mean, millions of retailer investors who follow Warren Buffett, and I'm sure that more and more investors were keen to invest more shares in Apple. This is the kind of things that are frequently overlooked here because honestly, if there could be a decline, a significant decline in the stock market price of this company, well, I would take advantage buying more shares. And you can imagine, for example, in the case of Berkshire Hathaway, would buy like crazy if it sees, for example, that the stock market price is declining something like, I don't know, 20%, 30%. Really, okay? Because remember that Berkshire Hathaway was buying more shares at a 150, at a 140. So this is the kind of thing that you need to bear in mind here. And probably this explains why, for example, in the case of the stock market price of Apple has not declined like many other tech stocks in the last 2 years, really. So, for example, you need to remember that many tech stocks in the year 2021 declined something like 50%, 60%, 80%, 90%, particularly those stocks promoted by Cathy Wood. But look at the case of Apple. Apple really just declined from its peak in the year 2021, something like, I don't know, 26%, 30%, but then it recovered it really fast, really. So this is the kind of things that I encourage you to take into account when you're investing in this company. Now, look at this. This is the revenue of the company here. We have mentioned the revenues here that this is not a company that could offer this kind of revenue growth of double-digit growth here in the next years. But look at this, that the free cash flow margins here has been impressive here. Look at this, that it offers more than 20%, some years 30%. And this is because, of course, Tim Cook has outsourced most of the manufacturing process in China because in China, companies, manufacturers like Foxconn offer, of course, a lower cost of the manufacturing process that contributes to increase the efficiency of the company and to increase, of course, the free cash flow generated by the company year over year here. And in this way, of course, the company is using a great part of that free cash flow generated year by year to make share buybacks to reward long-term holders. This is something interesting because most investors are overlooking this kind of moves made by Tim Cook in the past. And you know that Tim Cook is a genius in the supply chain management. Okay. So really this is not a surprise that the return of equity and the return of invested capital of this company have been really good here, increasing consistently here until reach these levels of return of equity and return of invested capital. Of course, you can see here that this increase in the return of equity and the return of invested capital is a result of the increase, of course, of the net income of over the years and the operating income as well. But at the same time, the denominator, which is the equity here, has been reduced year over year as well. Look at this, the downward trend of the equity here, year over year here. And this is because, of course, the company, as I mentioned so many times here, that the company likes to apply this kind of share buybacks program. And the share buybacks or the repurchases as an account need to be included as negative in the equity here. So really, if you want to know more about that with so much detail, I encourage you to watch my video of Hewlett Packard in this channel, in which I'm explaining there how the account, the repurchases, is included as part of the equity, reducing the equity, particularly in the companies that are making this kind of a strong repurchase of its own shares year over year. Okay, and then, well, this is another important point is that, well, this company did not need so much debt here. Look at this, that the company really doesn't need much debt, because in general the company in around 1 year the company can pay back all its long-term debt using just the free cash flow. Now another important point is that how the free cash flow was growing year over year here. Look at this, that the average was 14.37% here. So this is really, look at the rates. Yes, there are some years of the negative growth here. Look at the pace at which the free cash flow is growing in the case of Apple. Okay, this is important because the most important source for Apple to make these strong share buybacks programs is the free cash flow. And look at this, I think that this is the result of the enormous pricing power of the company that is offering, of course, expensive products, and most of the users buy these products offered by Apple and not from the competitors. So this kind of power really contributes enormously, and this is combined with the high quality management of Tim Cook. He has taken many decisions to increase enormously the efficiency of the company in the manufacturing process. So all this kind of combination of factors that are pointed to deliver long-term value for the shareholders, it what finally attracted a super investor like Warren Buffett here. Now, in this part, I want to share with you uh, different metrics here of Apple in order to be compared with those metrics of the other big tech companies here. Look at this. I'm taking here the free cash flow of the company in the last 10 years, and I'm taking the repurchases here. Then, well, I will calculate what is the percentage that these repurchases represent of the total free cash flow year over year. And here, you can see here that in general, in the last 10 years, Apple has used or has allocated an average of more than 80% of its total free cash flow to make more repurchases here. Now, if you compare the same figure or the same ratio with Microsoft, Facebook, Alphabet, well, look at this. Microsoft, just only 44% of its total free cash flow was oriented to allocate to make repurchases. In the case of Facebook, for only 40%. In the case of Alphabet, only 36%. And in the case of Amazon, almost nothing. Okay. Now, this is really interesting because here we are looking into just the numbers are telling us that Apple is the company from all the big tech that is the most shareholder oriented. Now, probably you would say that Apple the other companies like Microsoft or Alphabet are using more money to invest in their core businesses instead of making more repurchases. Now, well, if you have, for example, Tim Cook taking the leadership in Apple, it means that the company was carefully designed to be more efficient, to require less capital, okay, and in that way to have more free cash flow to finally reward the shareholders of the company. This is the kind of engineering that Tim Cook has designed over the last 10 years here. And this is the kind of thing that explains, for example, why Apple has experienced a significant capital appreciation in the last 10 years. And now, in order to reinforce my argument, I'm going to show you here another interesting ratio: the R&D expenses divided by the gross margin. Look at this because this is the average of the last 5 years, and Apple have only used only 15.61% of the total gross margin to R&D expenses. Look at this, how Microsoft is using higher percentage of R&D expenses of its gross margin. Facebook 27%, Alphabet 26%, Amazon 27%. So here, what the numbers are telling us is that basically Apple doesn't need so much R&D to spend so much R&D expense to keep its leadership in its respective industry. Companies like Microsoft, Alphabet, or Facebook require more resources to keep their respective business model strong in their. Probably you would say that yes, because well, Apple needs to rise the R&D expenses in order to be more innovative or something like that. But you need to remember that Apple have not need to launch so much abrupt innovations. The company has been releasing different interesting aspects about the smartphone. For example, that most of these devices are including the M1 or M2, which is one of the most advanced chips launched by Taiwan Semiconductor, or the fact that most of the components, a great part of the components of Apple devices are environmentally friendly, which is something probably you don't know about that, but something that these are subtle things that contribute to generate this kind of stickiness toward the brand. Another interesting point is how Apple, for example, has been communicating to the market that all the devices offered by Apple protect the data from the users, which is something that is critical. And for example, other companies like Alphabet or particularly Facebook or Meta had so many problems in taking care of the data from its users. From most of the users really values this kind of intangibles of the brand. Now, look at this, that in the case of, for example, of this ratio, we can reach the conclusion that Apple requires less R&D expenses in general because the company is more efficient. And even with that, the company has been the leader in its respective industry. Look at this. If we go, for example, here to the market share of the company in the year from the first quarter of the year 2021 and until the last quarter of the year 2022, look at the market share of Apple here and look at the market share of Samsung here. You need to remember here that we are talking about a company like Apple that offers and delivers the most expensive smartphone, because this is just referred to the smartphones here. This is really interesting because a company like Apple should have been, I don't know, probably at the end of this just with just 1%, 2%, because the products of the Apple's products are the most expensive ones. But no, but by the contrary, the company has been showing this kind of strength in its market position over the quarters here. And look at this. This is another interesting chart here that will reveals the power of this company. This is just about the smartphone industry here, okay? So if we take, for example, the shipment shares, Apple only concentrated 20% of the shipment shares of the whole smartphone industry. But at the same time, the company concentrates more than 80% or 80% of the total operating profits of the whole smartphone industry. How it's possible that something like that could happen? I mean, this reflects, of course, the enormous pricing power of the company compared to the competitors, for example, in this market. So if you have something like that, and if you remember here, Apple has been maintaining this kind of power in its respect in its industry, particularly in the smartphone, because you know that the iPhone is the most important product of Apple from the year 2015 to the year 2022. Here, we are not talking here about quarter, we are talking about years. Okay? So that reveals, of course, that Apple, the Tim Cook, has carefully designed a more efficient company that require less R&D expenses, in general less capital, because most of the manufacturing process has been outsourced to China. And then, well, with all this free cash flow generated by the company, thanks to, of course, to the higher efficiency of the company, the reduction of the cost as well, the company has more money to reward more the long-term investors here. These kind of things are critical to understand. For example, why Warren Buffett has concentrated in its portfolio something like 40% of the total Berkshire stock portfolio is concentrated in just one company, in this case, Apple here. Now, in this part, I want to share with you other important aspect of Apple here, the stock-based compensation of the company here. And well, I'm just taking the stock-based compensation of the company and dividing it by the free cash flow in order to see what is the proportion of the company here, the proportion of the stock-based comp here in the last years. Look at this, something between 8 and 9%. This is really, really acceptable here. And look at this in the case of Microsoft is a little bit higher, but it's still acceptable. And in the case, look at this in the case of Meta, 63%, 23%, Alphabet 32%, 23, 30%, Amazon 36, 32. I mean, these three companies, I mean, have an important, significant stock-based compensation as part of the free cash flow here. Well, you know that you should remember that stock-based compensation implies that the company needs to issue new shares to the respective employees, respective employees, and in this way, of course, the employees could make their trades. Okay, but this is important to notice that an important component of the stock-based compensation indicates that the company is increasing its outstanding number of shares year over year. And of course, you as a shareholder, if you are a shareholder of or any of these companies, I mean Alphabet, Amazon, or Meta, well, there is a possibility that your value is diluted. Your shares are being diluted because if you have more outstanding number of shares year over year, the value generated by the company in the year will be divided by a higher number of outstanding shares, which means that each share will have less value here. Okay, that's why it's important to control this kind of stock-based compensation here. And you need to remember that in the last weeks, of course, we've seen many news about massive sell layoffs in the case of Meta and Alphabet. And well, this is, I mean, for me, this reveals that these two companies didn't have a conservative forecast about their future requirements of resources. So, of course, right now they need to lay off so many people with so much indemnization, even when the market is seeing these kind of things as positive. Well, I think that in the future they will need again more employees to support the future growth of these companies. This is in the case of, for example, of Apple here, the company has not made any sort of layoffs here, like in the case of Meta and Alphabet, because the company is hiring gradually as the company is making very conservative forecasts of its future requirements of resources. This is really, really important here, and how we are discovering many different aspects about Apple that really make us think that Apple is carefully thought to deliver value, to offer the best quality products to the market, and the company is looking always for satisfying the desires of the users, and at the same time reward so much the long-term shareholders. This part, I want to share with you my calculation of the intrinsic value using the discounted cash flow methodology here, which is a method that fits well for a long-term holder here. So really, I am a long-term investor of this company, so for me, it fits really well the DCF here. Now, look at this, that the first thing that I will do is to show you what are the assumptions here that I'm making for this DCF here. For example, the free cash flow margins here, I'm assuming 25.89%, which comes from which is the average of the last 10 years here of all these metrics that I've shown to you previously. So we will maintain the average here of this free cash flow margins for the next years. Then, well, this is the official numbers according to the last reports of the year 2022 here, 394 billion of revenues. And, the revenues here has grown 7.8% this year. But in this year, in the year 2023 here, I'm assuming just a 3% for the following years here. For me, this is an acceptable rate of revenue growth for this company. Now, I'm just projecting all of this, okay? All of these numbers, this is the revenues projected here. And in order to calculate the free cash flow, the only thing that I'm doing is to multiply the revenues by the free cash flow margins that I'm assuming here, okay? So in this way, I have my projections of the free cash flow here until the year 2026 here. Now, in order to use the perpetuity here, in order to consider all this free cash flow from the future beyond the year 2027 here, well, the thing is that this is because, of course, I am a long-term investor here, and I'm planning to hold this company for several years. Well, the thing here is that we just apply this formula, taking the first number, the first term of this all this free cash flow that I'm not putting here. Okay. Now, if you take, for example, the formula of the perpetuity, you take the first term of the perpetuity and divide it by the discounted rate here of 8%, which fits well for a company like Apple, which is a rock solid business model, and then the minus 3%. This 3% means this growth is an annual growth that you're assuming for all these years here. Okay, this is something that you shouldn't forget here, because I will change all these assumptions in order to see how the intrinsic value could change according to the changes in the assumptions here. Okay, then, well, the only thing that I need to do is to calculate, because this is the present value of all this future free cash flow here. It is like the year zero here, but really we are in the year 2023. So we need to bring it back again, calculating the present value again of this number, of this present value here. And we will divide this 1 plus the discounted rate at an exponent 4, because there is here 4 years of difference. Okay. And then, well, this is the present value of all this free cash flow here, and we need now the present value of all this free cash flow here, which is the this number here. With this formula, you are using the present value. You are calculating present value of all this free cash flow here from the year 2023 to the year until the year 2026 here, applying, of course, the discounted rate of 8%. Now, this is the cash on balance in the balance sheet in the year as of December 2022, and this is the total debt of the company here as of December 2022 here. Okay, so calculating the enterprise value here, we are just summing all these perpetuity plus present value, and we are adding the cash, and we are subtracting the total debt of the company, and then we just need to divide this enterprise value by the outstanding number of shares as of December 2022 here, okay? Well, this is apparently the intrinsic value of the company, $124 per share, but most analysts do not take into account the possibility of the ARBR product. So I will add to this number the present value of the free cash flow that the ARBR products could generate for the company. Look at this. This is just the assumptions that I've taken for, well, reputable analysts who were following the launch of the ARBR products. And you know that these products, augmented reality, virtual reality products, are expected to be launching in 2023 here, okay? So we're considering here the growth rate for the sales of 40%, and we are considering the price of per unit of $3,000 per unit. And I am assuming here, this is my own assumption, free cash flow margin of 20% here, okay? Then, well, according to this analyst, it is estimated that in the year 2023, it could be estimated a sale of 1.5 million of units here. If we multiply this number of units by the $3,000 per unit, of course, we will estimate our revenues here, these revenues here. Now, if we project these sales here of units at a 40% here, which I'm estimating a 40% here year over year, you will have all these sales here, and if you can estimate, of course, the revenues estimated for the following years. Okay. Now, for calculate the perpetuity here, well, I'm just assuming a 6% here of growth here for this term, and well, we need to calculate here the present value of all this free cash flow here beyond the year 2031, and well, we are taking here the first term. We divide it by the discounted rate, which is the same discounted rate that we are assuming for Apple, for the whole company, minus 6% here, 6% of growth that we are estimating for this for each year here beyond the year 2031. Okay, and this is the present value of all this free cash flow here. For all this free cash flow here, and then we need the present value of all this free cash flow here. So really, we have the present value of all this free cash flow, and the present value of this perpetuity, and we have this number, and this number here, we will include this number within the calculation of the intrinsic value of Apple here. Look at this. This is the number that we are calculating for the ARPR products, and we are adding to the enterprise value here. And we are dividing just all these both numbers to the number of outstanding shares here. This is $142.27 per share. Now, most analysts just forget about the share buybacks effect here. And well, look at this, that this is interesting because, well, I'm just considering that the outstanding number of shares is being reduced year over year by 3% here. I have, of course, this information. As after the split in the year 2020, the outstanding number of shares were being reduced here at a pace of 3.6% and 3.2%. So I will continuously assuming at minus 3% of reduction. This is the velocity at which the outstanding number of shares are being reduced. So really, I'm really being conservative here, okay? And until the year 2027. Honestly, of course, we could expect that this number of outstanding shares could be reduced even beyond the year 2027, but we don't know, of course, if the company will apply certain, at some point in the future, the split policy. So, of course, I don't know what's going to happen in those years. So I prefer to stick to this number here in the year 2027. Now, the only thing that I will do is to consider here the enterprise value plus the present value of the ARBR products, and we will divide it by the outstanding number of shares that we are projecting for the year 2027. And in this way, we are estimating an intrinsic value of $169.13 per share, which is more or less in line with the current stock market price of the company. So really, the stock market price of the company apparently is not so much overvalued according to certain peer analysts who are just considering, for example, the price to earnings ratio to say that the company is overvalued because right now the price to earnings ratio of this company is something like 28 times earnings. But anyway, I would prefer to use the discounted cash flow methodology. And you need to consider that now Apple is growing its services business segment. So it means that if this service continuously growing in the next years, the market will be willing to pay even more multiples for this company. Now, what happened here? We are putting ourselves in a scenario in which there is no ARBR products here. Okay, so what happened here with intrinsic value here? Well, it will decline here from 169 to $147.89 per share. Now, it is in the case in which the ARBR products are not launched, and of course, nothing should be taken for granted. And of course, we need to consider, we need to put ourselves in the worst case scenario here. Okay. Now, I'm assuming at the same time that the company is growing its free cash flow at a 3% here. Look at this, that this is a really conservative, and even in the perpetuity, I'm just considering here a 3% here of growth for future free cash flow here, even beyond the year 2027. But look at this in the last 10 years. This is something that I gathered from the metrics that I've shown to you previously about Apple. The growth in free cash flow of the company was 14.37%. So really, I don't think so that the company will grow its free cash flow at just at 3%. It could be, for example, what happened if the company is able to grow at 5% for the following years. Well, look at the intrinsic value of this company, even not considering the ARBR products. This is just letting the possibility that Apple could surprise me in the future. Really, I just want to be more very, very conservative here. Very conservative, as I trust, of course, that the ARBR product will be launched. So I just let this number $169.13 per share. Now, of course, if there is the possibility that there is the ARBR products are actually launched, and at the same time the company could surprise me with a really decent growth in free cash flow really for the future. Look at this, that this is really interesting to notice in the future here. $253 per share here. When we are being conservative here, we are constructing a really an interesting margin of safety here for our investments. If our benchmark is 169 per share, well, you will have all the motivation or the incentives to buy at a price lower than $169 per share, probably 140, 150. And this probably could help us to explain why Warren Buffett was buying more shares at a 140, 150, because probably he was making the same exercise that I'm showing to you within this model here, because he is planning to keep Apple shares for the very long term here. Now, in this part, I want to share with you this simple exercise that will help us to understand why Warren Buffett will not sell any share of Apple stock here. Look at this. The first thing that I needed to do was to estimate the average cost of his investment in Apple. In order to do that, well, the only thing that I needed to do was to go to the SEC documents in order to see all the purchases that Warren Buffett has made in the last years since the year 2016. Well, I just dismissed some sales of his stock in these years, but then I could estimate something like $37.4 per share. Well, I will assume just $38 per share. Okay, so here we are taking, for example, the year 2016 here, because that is the year since he started buying the Apple stock here. Now, these are the prices of Apple stock at the end of the year, at the end of each year here, really. And well, we are gonna assume that in the year 2023, well, Apple stock will end up at $164 per share. If that's the case, the capital appreciation of Warren Buffett of holding this stock would be some 332% here, okay? And this is just the difference between these two numbers, the last price and the average cost, divided all by the average cost, okay? Now, the compound annual growth rate would be for this investment something like 23.23% of compound annual growth rates for these returns here, which is really an outstanding return for his investments. Okay. Now, we will assume here that the price that you are paying a price of $164 per share here, and for the next 3 years, we will assume here a really conservative a scenario for Apple, rather flat scenario for the next 3 years. Okay. Now, if you have bought in the year 2023 at $164 per share, and this is the scenario that is happening here, at the end of the year 2023, you will get at 13% of capital appreciation here. Okay. Now, this is not so bad, but of course it is not an outstanding returns for your investment. But what happened with Buffett here, with the Buffett's capital appreciation? Well, he will get a 386.8% if this is the scenario here, $185 per share at the end of the year 2026. But we will need to see what is the additional capital appreciation that Buffett is earning from the year 2023. And the only thing to do that is just subtracting both capital appreciation here, and you will get that Buffett is earning an additional appreciation of 55.3% here at the end of the year 2026, whereas just because you bought at a $164 per share, you are earning only 13% of capital appreciation here. So look at the great difference here of this capital appreciation in these two type of investors. Okay, now look at this. What happened, for example, if the price surpassed the $200 per share here? Well, the thing here is that, well, of course, you will improve your returns because you will get 28% of capital appreciation for your investment at the end of the year 2026, and Warren Buffett will get a 121% of additional capital appreciation here, just because he has bought at a really low price and he has held that stock for several years. So he's taking advantage of the compound effect here. Okay, so here we could get two important lessons here. First, we need to identify what are the companies that truly have this kind of compounding effect over the long term. And the second, and probably the most important factor, is to know what is the maximum price that you should pay for that company here. Look at this, that this is not the same, for example, to buy it at a $164 per share, whereas Warren Buffett has an average price of just $38 per share, just because he has bought the stock in the year 2016 when there was so much negative sentiment toward the company. I remember that I read many articles in that time that in which most analysts were saying that the future of Apple was really uncertain because they said that the competitor of Apple, for example, Samsung, was innovating its devices faster. Most of these analysts were concerned about the concentration of the total sales of Apple in just the iPhone, and the company was not developing new services. So really, in this case, of course, Warren Buffett was able to identify what is the most important factors that explain the moat of this company, and most analysts were not able to identify the moat of the company. They were trying to compare Apple with other big tech companies like Microsoft, Google, Meta, but that was not the path to find the answer here. Warren Buffett has said that he was able to identify that the brand in the case of Apple was so powerful that it doesn't matter if the competitors may try to surpass the innovation of Apple. The brand is so powerful that the users of Apple are so loyal to the brand that they will not change, even if the Samsung could be able at some point in the future to offer better products, better devices with more technology at a cheaper price. Of course, most of the users of Apple will not change their Apple devices because they love the brand. And now Tim Cook has made interesting moves in the last 10 years, reinforcing the ecosystem of Apple, launching new services to be part of the daily life of the users. So really, I think that the future for Apple is really promising. And with this exercise, of course, we have learned these two important lessons: to choose the right company and to choose, of course, the right price at which you should buy that company. So as you have seen, really, after all this comprehensive analysis about Apple, we have discovered different aspects that are frequently overlooked by many beer analysts. For example, the fact that Apple has positioned itself as a trustworthy brand in terms of the protection of the data of the users. The fact that I didn't know about this, but I needed to read a book that I will give you in the description of this video about the fact that Tim Cook was involved in many projects of social responsibility, for example, to increase the number of components that are environmentally friendly within the Apple's devices. I mean, and of course, Tim Cook has involved in several projects to improve the working conditions of the different suppliers, and that's how, for example, a CEO, one of the most important companies in the world, pressure the management of the suppliers in order to improve the working conditions of those employees. And of course, a gradual innovation that do not require so much capital. This is something that has been really good because, well, the thing is that the most of the products launch or the new models of the iPhone, the new models of the different Apple's devices have been successful over the years. And something that I like about Apple is the fact that the main purpose of those or all these strategies is to offer the better experience to the users, offering high quality products, but at the same time, the strategy of the company is to offer the highest reward in the long term for the shareholders of this company. That's why, for example, many times Tim Cook has repeated that Apple is carefully designed for long-term holders. So in that case, honestly, I don't have to worry about the quarterly reports because yes, it is possible in some quarterly reports there could be some negative sentiment toward the company, but we know right now with this video and all the most important things about this company that really make us think that Apple is really a special company, totally separated from the other big tech companies, which we just have explored, for example, the share buybacks, the splits of the company, the stock-based compensations of the company. All these things, of course, has carefully constructed to make the company more efficient, to deliver more free cash flow over the years, and of course to continuously make more share buybacks to reward long-term holders. Really, this is not a surprise why, for example, a super investor like Warren Buffett has allocated something like 40% of the total per share stock portfolio in just one company, in this case, Apple stock. So really, I hope that you really have enjoyed this video. Please put a like if you consider that this is a video that is adding value to your investment knowledge. Consider subscribe if you think that this channel could add value to your investment knowledge. Share this kind of videos to a colleague, to a friend, because I think that this kind of videos could be really helpful for them. So really, I will continuously delivering more and more information about different companies, different stocks, different concepts, always since the value investing philosophy point of view. So I hope to see you in the next video. Peace.